So welcome to chapter 11 from Principles of Finance. Now we're going to be talking about the cost of capital. The cost of capital, we call it the weighted average cost of capital, which is basically the average cost per dollar of capital raised. This is pretty simple. If we talk about the corporation, we're talking about the fact that they're using money that it does not belong to them, right? If you have stockholders, if you have bondholders, they put money in the corporation. That money is not property of the corporation. That money is being used by the corporation, and the corporation has the obligation to pay money back to their investors, either bonds or stocks. We need to pay money back, right? So that average, that total cost for us to being able to use that money is called the weighted average cost of capital. Think of it as the rent that we need to pay in order to use that money. So we're going to be working with weights. We worked with weights before, but this time we're going to be working with the weights of common stock, the weight of preferred stock, and also the weight of debt, the weight of bonds. Those are going to be based on market values, right? Remember, there are market values, there are book values. Market value is right now how much does it cost, right? Whereas book value is according to your accounting, what's the value of X, Y, and Z, right? So market values, we tend to say that they're more accurate. They reflect what the market believes of your business as of right now. Whereas book values is what we had in the business whenever we started. Right? So that's one of the main differences. Now, we have this rather long formula. At the bottom of this slide, I wrote the formula as a simplified version. That long E divided by E plus P plus D and so forth, those are basically the weights, right? So for some reason the book likes to expand it. That is just the weights, right? So the weighted average cost of capital is basically weight on equity times cost of equity plus weight on preferred stock times cost of preferred stock times weight on debt, cost of debt times 1 minus the corporate tax rate. Equity is common stock, right? So basically, we talk about equity, we talk about common stock. So if we dig into equity, how do we determine the cost of equity? There are two main formulas, two main approaches for us to calculate the cost of equity. The first one is CAPM, or the capital asset pricing model. The second one is the constant growth model. So we've seen this before in our previous chapters. Right? So this is more of a review rather than new material. So the CAPM is a very good approach. It uses market value, market information. If we don't have good historical data, it is kind of difficult to use it. This formula is how it is, right? Now here's the thing. I said it a little bit wrong a minute ago. CAPM is forward looking. The growth model relies on whatever we've done in the past, right? So CAPM is the preferred method for calculating our cost of equity. Now, CAPM and I'm going to go forward. The constant growth model, there are two ways. We've seen both formulas before. Theoretically, both answers should be the same. However, that's not going to be the case, right? Since most of the times the two answers are not the same, we're going to average them out, right? So if one is 10% and the other one is 12%, we're going to average them out and we're going to say that the cost of equity is 11%. Now, if we talk about the cost of preferred stock, same formula that we've used before, right? Is the constant growth model, but with no growth, right? The dividends in preferred stocks are not going to grow, right? So therefore, we have the dividend divided by the price. The dividend divided by the price, same thing. Now, if you remember, or you can go back and see the formula, there is the part of debt is being multiplied times 1 minus TC. And 1 minus TC is 1 minus the corporate tax rate. The tax rate should be always entered as a decimal. So once we do that, since interest payments are tax deductible, we have a tax benefit of paying interest. Our taxable base goes down as we pay interest. So at the end, we end up paying less taxes. So that's one of the benefits that gives us having debt, right? So we do a couple of steps. First, we do the yield to maturity, same step as in chapter 7. And then, there it is. That long formula, you can do it in just with debt to maturity. Yield to maturity. Then you multiply 1 minus the tax rate, and the rate is going to go down even further. Now that's one of the things that matters about debt. We have a tax shield, we have a tax benefit. That is going to be advantageous for the firm. Now that does not mean that we should abuse of this, right? No, we should be very, very careful on the way in which we manage our debt, because as we keep on adding more debt, the cost is going to go up. Now finally, we're going to have to calculate the weights. We're going to have to see how many shares of stock, common and preferred, do we have, and then we multiply by the current price. And then we do the same with debt, the number of bonds that we have, and then we multiply them by the current price. We add everything up, and then we divide each component by the grand total. There's an example that